Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
Yeah, it's great to be here. And honestly, looking at the data we have on the desk today, insight is exactly what everyone is scrambling for right now.
No kidding. It's January 21st, 2026. The holiday fog is lifted, and the global economy is looking, well, it's a little schizophrenic. We've got this fascinating split screen thing going on.
That's a good way to put it.
On one side, you have the U.S. with President Trump back in office, and the markets are they're reacting in this really volatile, almost psychological way.
It is a total roller coaster over here. Yeah.
But then you look across the Atlantic to Europe, and it's a completely different vibe. It's heavy, it's structural, incredibly rigid. The EU is dropping the hammer on tech in a way that is going to force billions of dollars to move.
That is the perfect way to frame it. You have a tale of two worlds, really. The U.S. market is running on pure psychology, basically a game of chicken between investors and the White House. Meanwhile, Europe is moving toward absolute legal certainty. And as any CEO will tell you, that certainty, it usually comes with a very, very high price tag.
So our mission for this deep dive is to unpack these two colliding trends. We need to explain why they matter, to your portfolio or even just your understanding of the world this year.
Okay, let's do it.
First, we're going to look at the EU getting really tough on Chinese 5G, specifically why the era of asking nicely is just over.
Completely over.
And second, we have to break down this trading strategy that's all over Wall Street chatter right now. They're calling it the TACO trade.
TACO. It sounds ridiculous and it makes me hungry, but it is a genuinely high-stakes game that investors are playing with the administration.
I love a good acronym. But before we get to the tacos, let's fly to Brussels. We've been tracking the language from the EU on companies like Huawei and ZTE for years. But looking at the official policy documents and the data analysis from this month, the shift it's dramatic.
It's a total regime change. To understand why this is such a big deal, you have to rewind a bit. Back in 2020, even up to 2023, the EU was operating under something called the 5G cybersecurity toolbox. Now, despite that aggressive name, it was essentially a recommendation.
It's a suggestion.
Exactly.
Right.
It was the European Commission telling member states, look, we strongly suggest you assess the risk of these high-risk vendors.
Strongly suggest.
Yeah.
In my experience, that's code for, I want you to do this, but I'm not going to check.
Right. It creates wiggle room. And because it was just a suggestion, you saw this completely fragmented response. Germany dragged its feet. Spain was slow. It was a patchwork. But as of January 2026, that era is dead. We're moving from the toolbox to the Cybersecurity Act.
And the difference is the jump from guidance to actual law.
Binding law. And the European Commission has laid out a framework that it's remarkably strict. Telecom operators now have a hard timeline, 36 months.
3 years.
3 years to strip out what they define as critical core equipment from any high-risk vendors.
3 years. That sounds like a decent amount of time until you realize the sheer scale of the infrastructure they have to replace. I want to use an analogy here because I think it helps visualize this.
Go for it.
Think of it like a homeowners association and HOA.
Oh, boy.
Right? Back in 2020, the HOA sent you a polite letter. It said, hey, we'd prefer if you didn't have that specific type of fence.
And you probably just tossed that letter in the recycling bin.
You can totally ignore it.
Yeah.
But now, it's 2026. The bylaws have changed. You just got a certified letter. It says you have 36 months to tear that fence down. If you don't, we are fining you every single day. It's no longer a choice, it's a rule.
That captures the financial reality perfectly. In the boardroom, ignoring a recommendation is a strategic risk. You debate it. Ignoring a law like this, that's compliance failure.
Which sounds like the kind of phrase that gives a CFO a cold sweat.
It should. It becomes a line item on the profit and loss statement. So the whole conversation shifts from, can we afford to replace Huawei, to, can we afford the fines if we don't?
And the fine is always higher. And we aren't just talking about, swapping out a few antennas on a cell tower, are we? I was looking at the scope of this draft regulation, and it seems way bigger than just telecom.
That is the part the market is underpricing right now. Everyone focuses on 5G because that's what you see. But the draft regulation covers 18 critical sectors.
18. So we're moving way beyond smartphones.
Way beyond. We're talking about the power grid. We're talking about medical devices in hospitals, cloud computing infrastructure that runs banking systems. The EU is framing all of this as tech sovereignty.
Whoa, okay, let's pause on that. So if I'm a hospital in France and I bought, say, a fleet of connected MRI machines 3 years ago that use a Huawei-built module, am I suddenly on the clock?
Potentially, yes. If that equipment interacts with critical data infrastructure, you are suddenly part of this sweep. That's why the cost estimates are just ballooning. It's not just the telecoms of the world footing the bill anymore.
Naturally, Huawei isn't taking this well. I saw their press release. They're coming out swinging.
No, they are furious. They're calling it discrimination based on nationality, which, to be fair, it explicitly is. They're threatening lawsuits, citing WTO rules.
And legally speaking, they probably have an argument, right? You usually can't ban a product just because of where it's from. But the EU has a trump card.
The ultimate trump card, national security. Or in this case, the phrasing they use is supply chain security.
Which is like playing an ace in poker. It usually overrides everything else.
Almost always. The EU isn't defending this by saying, we want to help Nokia make money. They're saying, we cannot have our power grid controlled by a vendor subject to an authoritarian government. Once you frame it as security, the courts, they generally step back.
So for anyone listening, trying to figure out where this is all going, the takeaway is don't bet on the lawsuit stopping this.
Correct. Do not bet on a rollback. The train has left the station. The legal battles might delay things a bit, but the policy direction is set. The only real variables left are the speed of replacement and, crucially, who picks up the check.
That brings us to the who benefits question. Because money doesn't just disappear, it moves. So if billions are being forced out of Chinese vendors, where does that money go?
It goes to the alternatives. We're talking about a massive transfer of profit. This is what we call policy-backed demand. It's sort of the holy grail for a company.
Policy-backed demand. That sounds like a polite way of saying the government is forcing people to buy your product.
Essentially. If you are Ericsson, if you're Nokia, or even Samsung on the fringe, you've just been handed a guaranteed market share expansion. You don't even have to have the best product or the lowest price. You just have to be compliant.
So the carriers take a hit, but the Western vendors get a 3-year boom cycle.
That's the smart play.
Okay, so that's Europe. Rigid, legal, a paved road with a clear destination, even if the toll is expensive. Now, let's pivot back to the United States. Because if Europe is a paved road, the U.S. market under President Trump right now feels like off-roading with no brakes.
That is a terrifyingly accurate image. But yes, that's the feeling on the trading floor.
We're looking at reports coming out of Davos this week. It's January 2026, and the buzz on the trading desks isn't about climate or crypto. It's about TACO.
TACO.
And for anyone who hasn't been glued to their terminals, this stands for Trump always chickens out.
It is blunt. And, a little disrespectful maybe, but it captures a very specific, actionable sentiment that traders have locked onto.
So let's unpack the mechanics here. How does the TACO trade actually work?
It's what we call an event-driven strategy. The hedge funds have identified this loop, this cycle that just keeps repeating. It starts with step one, the threat. Trump announces a massive tariff or some policy shop, something like, I'm putting 100% tariff on this country.
The classic opening bid.
Right. And the immediate reaction, step two, is market panic. Stocks drop. The sectors he targeted sell off hard.
So the market bleeds, everyone gets scared.
But then comes step three, the pain point. The economic cost of that threat becomes real. Maybe the stock market crashes too hard, which he hates. Maybe allies push back.
And that leads to the chicken out.
Exactly. Step four is the retreat. He delays the tariff. Or he announces a great meeting and a new framework. The threat just evaporates.
And step five.
The relief rally. The market realizes the world isn't bending, and stocks bounce back, often harder than they fell.
So the TACO trader just waits for the scary tweet, buys the panic when everyone else is selling, and then waits for the inevitable blink.
It is buying the dip, but weaponized. And we saw a textbook example of this, literally this week.
The Greenland incident.
The Greenland incident, yeah.
For anyone who missed this, President Trump threatened massive tariffs on Europe linked to a dispute over purchasing Greenland.
Which came out of left field for almost everyone. It sounded absurd.
But the market took it seriously. For about 6 hours, markets dropped, and then...
Then Davos. Trump meets with NATO leaders, he does some photo ops, and suddenly he comes out and says, there's a framework of a future deal on strategic cooperation in the Arctic.
The classic pivot. We made a deal, folks.
Exactly. He walked back the threat, and the market recovered half its losses almost immediately. If you bought that dip on the Greenland headline, you made a killing by lunch. The TACO traders won.
It feels like a cheat code. But, and this is where it gets really interesting, analysts at places like Bloomberg are starting to wave a red flag. They're calling this a self-defeating prophecy.
This is the paradox. and it's a dangerous one.
Walk us through that. How does a winning strategy defeat itself?
Okay, think about the incentives. The TACO trade only works because of market pressure. The reason Trump chickens out is usually because the stock market drops. That drop is the signal that says, Mr. President, this is a bad idea. Stop.
It's the feedback loop. The market votes no.
Right. But what if everyone believes in the TACO trade? What happens when he threatens a new tariff?
Everyone buys the dip immediately, so the market doesn't drop.
Precisely. The market stays flat or maybe even goes up. And if the market doesn't panic, Trump gets no negative feedback. He looks at the Dow and says, hey, the investors love this idea.
Oh, wow. I see. By betting on him backing down, we remove the very pressure that makes him back down.
You got it. You remove the guardrail. If the market becomes too cynical, too confident that it's all a bluff, they inadvertently give him the green light to actually pull the trigger.
That's wild. It reminds me of the game Chicken from the movies.
The car analogies are strong today, but it really fits.
Stick with me. You're the market, driving your car head-on at another car driven by the president. Historically, he always swerves at the last second.
Right, that's the assumption.
But the only reason he swerves is because he sees you coming and gets scared. If he looks over and sees you've already pulled over to the side of the road because you assume he'll swerve, well, he has no reason to hit the brakes. He just keeps driving straight.
And then you get a head-on collision, real tariffs, real trade wars. The strategy of he always swerves only works if the threat of the crash looks real to him.
That is a psychological brain twister. It's 4D chess.
It is, and that's why the smart money is warning that this is a conditional strategy. You aren't really trading the policy, you're trading the policy reaction function.
Meaning you have to watch the reaction, not just the news.
You have to watch the pain threshold. At what point does the market drop enough to force a negotiation? If investors stop reacting, that threshold moves. We might see tariffs actually stick in 2026 simply because the market stopped punishing the threat of them.
That is a crucial distinction. You can't just run this play on autopilot.
No, you have to be contrarian to the contrarians.
So let's bring these two massive threads together for our listeners. We have the Eurozone and the U.S. zone.
Two very different operating systems.
On one side, we have the EU moving away from ambiguity. They're laying down hard laws, 3-year timelines. It's a world of increasing certainty, even if that certainty is expensive.
Correct. The risk there is execution. It's a spreadsheet risk. It's calculable.
And on the other side, here in the U.S., we have volatility driven by a psychological dance, the TACO trade, a game of bluff and double bluff.
Where the risk is misreading the psychology, in Europe you read the law, in the US you have to read the room.
For the investor, both require looking past the headlines. In Europe, don't just read Huawei ban. Look at those 18 sectors. That's where the hidden costs and opportunities are.
And in the US, don't just read Trump threatens tariff. Watch the VIX. Ask yourself, is the market scared enough? If the market is yawning, the tariff might actually happen.
It really highlights how you can't just be a passive observer in 2026. You have to understand the mechanics behind the news.
Absolutely. And this raises a really uncomfortable question for everyone to think about.
What's that?
If the TACO trade becomes the default, if the market effectively stops reacting to political threats because they assume it's all just a game, does that actually make the world more dangerous?
Because the financial check and balance disappears.
Exactly. The stock market has historically been a voter. It votes with its wallet every second. If it stops voting no on trade wars, we might just end up with a lot more of them. Our own cynicism as investors might enable the very instability we're trying to hedge against.
That's a heavy thought to leave us with. The idea that by betting on safety, we might be creating danger.
It's the paradox of the new year.
Well, on that note, we're going to wrap up this deep dive into the hidden mechanics of 2026. Whether you're tearing down your fence to appease the HOA or playing chicken with tariffs, we hope this gave you a clearer map of the terrain.
It was a pleasure to break it down.
Thank you so much for listening. Don't forget to subscribe and hit that like button. See you next time.